One of the buzzwords that is being used in discussing performance of financial institutions is fintech. So we'll be discussing recent fintech advancements. Adoption of technology has enabled financial institutions to continuously increase efficiencies, lower intermediation costs, and increase profitability. Fintech has grown rapidly during the last decade and is now posing challenges to both traditional banking business models as well as traditional supervisory methodologies. There are opportunities as well. In addition to increased efficiencies, products and services, fintech also offers opportunities for unbanked and underbanked population. This is primarily due to the use of smart mobile phones as a main channel to deliver fintech-based banking services. Accordingly, it is evident that fintech provides opportunities for more competition, increased efficiency, and reduced intermediation cost in banking business. However, complacency on the part of traditional banks will see them rapidly losing business to emerging fintech-driven companies. Fintech innovations that will impact traditional banking could be identified as virtual banking, open banking, peer-to-peer lending, and digital currencies. Virtual banking, a bank that offers its services entirely through electronic means without requiring physical interaction with customers, is considered a virtual bank. Consequently, banking operations are being executed via mobile applications or through internet banking. This demonstrates the most popular digital banks in every country. Accordingly, we can see in USA, the most popular digital bank is Square. And there are so many other popular digital bank in different geographies as well, including Southeast Asia and South Asia. The UK's most popular digital bank is Monzo. In the US, it is Square. Ubank is Australia's most popular digital bank. Revolut is the most popular neobank in 17 countries. There are some reasons for shifting people from traditional banks to virtual banks. In the context of Southeast Asia, those reasons have been identified as lack of personalized advice and high fees, as per BCG research. Number two, we are discussing is open banking. This allows consented third parties to access customer data in a bank using application programming interfaces known as APIs. This enables third-party fintech providers to present a variety of solutions to customers such as mobile applications that allow accessing customer data from different financial institutions and easily perform transactions using multiple banks. With an open banking framework, consumers and businesses are empowered to share their financial data with a broader range of financial service providers. This incorporates effective safeguards that ensure the stability of the financial system. Open banking holds the potential to reduce consumer costs, improve their ability to manage financial services as well. This depicts the open banking across the world. In the geographies where it has been colored in dark blue, such as Brazil and Australia, India, UK, and EU, these are mandatory or compulsory. However, in some geographies, such as Russia, Canada, those are still not mandatory. However, those are on voluntary or regulatory guidance basis. Open banking initiatives. In 2018, BBVA launched its Banking as a Service platform, the US. HSBC also launched its Connected Money app in May 2018 in response to the UK's open banking regulations. Subsequently, Barclays claimed to be the first UK bank to enable account aggregation inside its mobile banking app. API banking in India started with Yes Bank and RBL Bank taking the lead in 2017. Most significant players like ICICI Bank, Axis Bank, Kotak Bank, and smaller players like SBM, AU, SFB, Equitas, SFB have now established comprehensive API banking platforms. Now we are discussing on peer-to-peer lending platforms, another innovation by Fintech. These platforms intended to directly connect lenders and borrowers, thereby drastically reducing the cost of financial intermediation. These initially emerged as an alternative funding source for unbanked and underbanked customers. The global peer-to-peer lending market was worth over $83 billion in 2021, according to figures from President's Research. This is projected to reach over $705 billion by 2031. This shows Europe's top 11 peer-to-peer lending platforms, including Pixura, Fox Money, Lendix, CreditGate24, so and so forth. Now we are moving to the topic of digital currencies. The emergence of digital currencies is probably the best fintech-driven challenge faced by traditional monetary and banking systems. There are two types of digital currencies, namely cryptocurrencies and central bank digital currencies or CBDCs. Cryptocurrencies are not issued by any central authority such as a central bank. This also makes cryptocurrencies less affected by government interventions and thereby possibly impacting the effectiveness of central bank monetary policy. On the other hand, CBDCs that will be issued by a country's monetary authority will act as a digital token of the country's official currency. This depicts how the usage is cryptocurrency as of now. In Nigeria, Vietnam, and Philippines, this is more than 25%. However, in advanced economies such as China, US, Germany, and Japan, it is relatively less as per Statista data. This demonstrates usage of CBDCs. Accordingly, Bahamas becomes the first country to officially launch a CBDC. Subsequently, UK, US, and Eurozone central banks as well as Asian central banks have initiated CBDC projects as well. Risk of fintech. The rapid emergence of fintech has given rise to potential new risks relating to technology, data governance, and market conduct. This poses the need for a supervisory approach that supports fintech adoption by the banking industry. Regulatory and supervisory approach towards fintech. There are two extremes in the supervisory approaches. First is a laissez-faire approach, where innovation is permitted without any supervisory intervention. The other extreme approach is to limit innovation only to the product and services desired by the supervisors. Now we are moving on to supervisory technology, known as subtech. Adoption of technology for supervisory practices that enable effective supervision with the use of limited resources and a focus on risk and stability of financial institutions has become imperative. The adoption of subtech by banking supervisors will have a deep impact on how banks are supervised. There are subtech capabilities for banking supervisors, namely supervisory information systems, advanced data analytics capabilities, use of AI systems. In Sri Lanka, there are CBSL initiatives on fintech. This regulatory framework on technology risk management and resilience introduced in 2021. Proof of concept on KYC data sharing, which was in 2021. Regulatory sandbox, which has been launched in 2020 for testing products and services without risk of infringing a regulatory requirement. References for this presentation have been extracted from CBSL press releases. World Bank working papers, as well as from ADBI working papers. Thanks for watching.